Welcome back to Economic Outlook. Now last time, we looked at the recent rise in oil prices and some of the factors that may have contributed to the increase. Today, we're going to look at the corresponding movement in gasoline prices and how these increases are impacting American consumers on a daily basis. We'll start with a careful analysis of where gasoline prices have been and where they may be trending in the future. We'll conclude with a look at how this increase in gas prices has spilled over into other areas of the economy and see how consumer behavior is changing and how other industries are impacted. We'll start our analysis by looking at real gasoline prices since the mid-1980s. Now, just like in our oil discussion, I've adjusted these prices using the CPI to reflect May 2008 dollars. That way, it's easier to compare prices across different time periods. Now, as you can see from this chart, gas prices were relatively low in terms of today's dollars all the way through the end of 2001 after the September 11th terrorist attacks. In fact, gas prices were consistently under $1 a gallon. Gas prices began to increase much more rapidly after the September 11th terrorist attacks, and our next chart shows us what's happened since 2002. Here you see gasoline prices begin their steady march upward. However, starting in July 2005 and after Hurricane Katrina and Rita, we saw increased volatility in gasoline prices alongside steady increases. These two charts both show the incredible rate of growth in gasoline prices over time. Since the mid-1980s, real gas prices have increased almost 7 times at a rate of about 9% per year. But if you look at 2002 and onward, gas prices have increased 4 times since then, at an incredible rate of 25% per year. That's almost 2% per month. These growth rates in gasoline prices are especially concerning to consumers. To show this graphically, I've prepared a chart that depicts how long it will take for gas prices to hit $10 per gallon given different rates of growth in gasoline prices over time. So for example, in the past 72 months, we know that gas prices have increased around 9%. Given that 9% growth annually, it will take around 63 months for gas prices to increase to $10 per gallon. Now I've calculated other growth rates over shorter periods of time because as we've seen, the rate of increase has been much greater in more recent months. This chart shows how long it will take gas prices to hit $10 per gallon. I've calculated this based on 2 different May prices of gasoline. When the EIA data was last updated, gas prices were at $3.72 per gallon. However, in the final days of May, prices actually rose to $4 per gallon, and that dramatically impacts the time it will take for gas prices to reach $10 per gallon. For example, if we look at the growth rate over the past 3 months, and assume that gas prices in May at $4 per gallon, gas prices will actually hit $10 per gallon in less than a year. And it's even more substantial if we look at the single month growth rate for May. Now, it's really important to note that I don't expect gasoline prices to actually keep increasing at these rates. Supply and demand factors probably wouldn't allow it because at this rate of increase, demand will eventually slacken. However, this is really just a graphical representation of how dramatic the increase in price has been over the past 3 or 4 months. For example, if we look at data since 1986, it would take almost 10.5 years using that annual growth rate for prices to reach $10 per gallon. However, if we look at the past 2 months, it would actually hit that mark in less than a year. So this just gives some perspective on how rapidly gasoline prices have grown over the past year. Now that we've seen how rapidly gasoline prices are increasing, it's important to understand what's driving the increase. Now, the first thing you would suspect is that oil prices affect gasoline prices, and that's absolutely true. As you can see from this chart, gasoline and oil are very correlated. In fact, the correlation coefficient is 0.97. That's almost as close as you can get to a perfect correlation of 1.0. As we just saw, oil prices and gasoline prices are highly correlated. However, there are several other factors which could possibly impact gas prices, so we need to look at those as well. We'll start by looking at end-of-month oil stocks. This is the amount of crude oil we have on hand ready to send to a refinery at the end of any given month. Now, it makes sense that these two would be correlated, because the less oil we have on hand to send to refineries, the less able we are to replenish the gasoline that we use in a given month. So if a geopolitical disruption causes a drop in oil stocks, we would think that gasoline prices would increase. So let's look at the data and see what it shows us. This chart shows real gasoline prices versus end-of-month oil stocks. Now, these two have a correlation coefficient of negative 0.27. We would expect the correlation to be negative because a drop in end-of-month stocks should increase gasoline prices. However, the strength of the relationship is very small. If we look at the same correlation coefficient for a much more narrow time period from 2002 onwards, we actually see that the correlation coefficient is equal to 0.46, meaning that as oil stocks increase, gasoline prices also increase. And this doesn't make logical sense. There's not really any good reason why increasing oil stocks should lead to increased gasoline prices. So it looks like this factor probably doesn't have too much bearing on the actual price of gas. One important aspect of end-of-month oil stocks is domestic oil production. Now, since the 1960s, we've actually seen declining oil production in the United States. And this next chart shows us what happens to gasoline prices when there's an unexpected drop in domestic production. Here we see production for both continental United States and Alaska. After Hurricanes Katrina and Rita, we saw a drastic drop in domestic oil production and a subsequent rise in real gasoline prices. However, the actual number of barrels per day that we receive from domestic production pales in comparison to the oil we receive from places like Canada and Saudi Arabia. The fact that there's not a strong relationship between oil stocks and domestic production to that of gasoline prices tells us something really important. This shows that the price of oil, and therefore the price of gasoline, is no longer controlled by the demand of the American consumer. And this is really profound, because it's the first time, really since oil became a global commodity, that oil production hasn't been driven by domestic consumer usage.